Good morning. This is Axel Merk, President and Chief Investment Officer of Merck Investments. Happy Wednesday. I've a few days here. Wanted to just gauge whether I should adjust and how and when I talk. And today I couldn't resist with gold breaking out, currently up at 18.10, up 16 bucks or 90 basis points, firmly above the psychologically important 1800 mark. The gold futures are at 1822. Rest of the market is risk on. Futures are up 24 points. The 10-year is down 7 ticks at 66 basis points, and the 30 years up is down 21 ticks. Now, I have been reading a few metrics that are mostly crisis related. The 3-month T-bill 14 basis points and the 3-month LIBOR 28 basis points. Remember, that was over 1% a few weeks ago, and the effective Fed funds rate at 9 basis points. But what I have not been giving you is the steepness of the yield curve. That's actually something we internally look much more at. The 3-month LIBOR rate is of course interesting when you have stress in the system. But when we talk about the steepness of the yield curve, it's the relationship between the short-term and the long-term rates. And it's relevant to see how much stimulus there is in the economy. And if you look at the steepness of yield curve, it was one of the few indicators that predicted the virus. And obviously, that's I say that a little bit tongue-in-cheek because obviously nothing was able to predict it, but based on the chart anyway. The 3-month versus 10-year has been and also the 2 years versus 10-year relationship had been indicating that we might be heading into a recession, and that usually happens is that the yield curve gets inverted, and then the stimulus is starting to come, and with that there's a steepness coming, and that's how we have that. But the reason I mention it today, the difference between the 3-month and the 10-year is 52 basis points. The difference between the 2-year and the 10-year is 50 basis points. So basically, between 3-month and 2 years out on the yield curve, it's dead flat. I mean, 2 basis points. Yesterday it was 0. And that is a sign of the Fed really trying to keep short-term rates low, depressing that at just about any cost. Let me just get my disclosure in here before I forget. On world markets, they actually a bit mixed today. The Euro Stoxx is down 76 basis points. Nikkei is down 78 basis points. Hang Seng Index is up 60 basis points. Hong Kong is in the news because apparently there's some chatter about whether the administration wants to kind of help break the peg in Hong Kong. A lot of talk about currency manipulation and whatnot. China has not been manipulating its currency. That's plain and simple. If anything, they kept it from, and it's certainly not in the sense that they have been artificially trying to weaken it. In fact, they had intervened to try to strengthen it. And in Hong Kong, we've had a peg, and clearly some people are suggesting maybe something should change. The stress, at least as of now, as I'm speaking here, there has been very little stress in the Hong Kong dollar. In particular, if anything, there have been some movement for the Hong Kong dollar to move higher rather than lower. And that can, of course, change, right? And especially if politicians are starting piling on it and saying we got to tear that peg apart. And also noteworthy today, the CSI 300 Chinese index is up 1.6%. Yesterday was down 1% or so, but then the 2 days before it was up quite substantially. And with the U.S. closed on Friday, the ETFs were up quite substantially there. And no investment recommendation on any of those. And yeah, Australia is down 1.5%. In any case, gold miners are doing very well. The dollar is broadly weaker, and the commodity currencies, Swedish krona and Norwegian krona, lead the pack at 78 and 70 basis points respectively, with the weakest currency in the G10, the Japanese yen, up only 1 basis point. And so a few other things are happening. One thing I want to talk about briefly is I I say I'm reading books. I'm listening to a lot of audiobooks these days. I don't have much time to actually read. I used to then listen to the audiobooks on my commute, at least when I'm not too tired and I don't listen to the news. And so I've been reading a bunch of books. I try to get them throughout the political spectrum. They tend to be on the economy, or some background stories on things. And when I talk about background stories, I sometimes read books that are going 1,000 years back and the like. So lots of lots of background, I suppose. But currently, it's very contemporary. It's John Bolton's book that I'm reading. And first, I can see how the White House was rather upset that he published the things he did. I guess they have scrubbed the um, uh, some things that are classified, but you clearly get a very good understanding how the different actors are thinking. And so, if I was in the White House, I wouldn't necessarily want that to come out. But anyway, it is out. Needless to say, the one thing I think everybody agrees on is that Bolton has a different view on the strategic defense path that you should take than many others, and including Trump. There's been some overlap, but somebody like Bolton is bound to get frustrated with somebody like Trump doing it. But obviously, he goes way beyond it and goes on the offensive, taking many things apart. And the one thing he then lays out in detail is how President Trump is, according to him, wavering on many things, sometimes changing his mind and whatnot. And surprisingly, this book even touches on COVID, and that's part of the reason I mention it. Normally, when you publish a book, you take a long lead time. At some point, there's a drop dead point, and at that time, you don't change anything anymore. But apparently, he was able to get things in from February. Um, and part of the reason he mentions that Bolton was in charge of the NSC, the National Security Council, and they have a broad range of security related things, but one of them was pandemic preparations. And there'd been a lot of talk about um, that some groups were dismantled and whatnot. And he says that's all politics. He strengthened it, and obviously you might read it yourself, make up your own mind. But I'm just giving his perspective here, or trying to paraphrase it, where he said you need to streamline these things. You need to reduce the number um, of points where some of the decisions are made, where the information is gathered to be more effective. And if anything, he worked hard of kind of equating pandemics with bio warfare, because the sort of response is similar and the sort of national response is similar. And he obviously has been out of the administration now for many months, but he did say he put everything in place to be ready for the pandemic. And indeed, apparently, the NSC had not just caution and warned in January, but also gave an action plan. And so he squarely blames Trump for the lack of action on taking measures early. Obviously, that's a very political hot potato. What's noteworthy about this is a Republican, and he obviously has gotten off on the, well, not maybe off on the wrong foot, but he has not at some point distanced himself from Trump on various things. But he he puts that into a context of not making decisions or wavering on numerous other topics, and so it's always interesting when you read about these things. On when they come in, they say, yeah, the president calls the shots, but then of course they have their own views, especially the more experienced they are, and so there's bound to be a conflict. But in any case, he seems to strongly disagree on what's been happening there. So back to the markets. Jeremy Siegel spoke on Bloomberg Radio this morning and pointed to M1 growth. That's the money supply growth. And he says that historically that's led to inflation. There are numerous people that argue that this time is different and whatnot. What he's pointing out is that he's not worried about inflation today, but next year. And the thing is that people will have a lot of money in the bank account. People have been um, kind of putting money aside to be safe, right? And then of course some of that money you could argue will go into the stock market, but he's arguing, no, this is money the consumer will go ahead and spend. And so I have been arguing that the Fed not even thinking about inflation is not appropriate. That's part of their core job description. And even if they're not the baseline scenarios, they should think about them. Now, Powell's attitude seems to be, hey, we have an economy in crisis. We need to, and we have to fix the problem now. If we have a different problem tomorrow, we'll worry about that tomorrow. But we've shown before this economic downturn that we can go to record low unemployment and then some and not have inflation. And therefore, we'll do exactly the same thing. It's in that context. And of course, part of the reason he says we're not worried about inflation is so that people are not pricing in any interest rate hikes. And that's he's achieving that. The question is this going to be beneficial to long-term economic growth? And it is not if indeed inflation is going to be an issue. I have been in the camp saying, yeah, we could get these inflation expectations unanchored. It might sound academic, but part of the reason inflation is a mind game more than a price game. If you see all your neighbors hike prices, you are induced to hike prices. If you see that your most precious things go up in price everywhere you look, that's when you go things up. And it's not a uniform level rising of a price level. Things will go up in different spots. And so similarly, when prices are plunging, that creates a sort of atmosphere. Oh my God, you got to compete on price and so forth. And because of the enormity of the shock we have, I can see that the anchor is actually happening on the downside. And then as we kind of the volatility comes in on the economic recovery, we could see some things on the upside as well. Then, since we are all backseat epidemiologists these days, brief comment. A lot of the numbers are rather confusing, simply because they're not standardized, not cleaned up. So one of the things I've been doing is I've been looking at the California data more detailed, because at least you have a somewhat more consistent data set. Now, that said, within California, some sick people from Southern California are moved up to the Bay Area here where I am, for some load balancing of the whole hospital beds, and so the hospitalization rate where we are is higher than would be an indication. Now, that said, there's a good website, calmatters.org, that shows things county by county in California. And if you go through the top 20 or so counties, all but the two top counties, and top meaning the highest hospitalization rate, have trends that are moving upward, and that is, of course, not good. That is concerning. And so we'll see how that's going to play out. There's a decision that's obviously been made not to have a major shutdown again, and we just have to learn how to deal with this. And the good news is that I see a lot of people, if not everybody, wear masks when they are out and about and near other people, and that's probably one of the easiest thing and best things we can do. The other thing I see is everything seems to be getting more bureaucratic. I was in the office is my office in San Francisco, for the fourth time in about 3 months, on Monday, and I have not seen the city as empty. Now, it could be for past 4th of July that everybody's on vacation, but what I have seen is that more and more signs are coming up and more rules are coming up. And so now we have a pretty picture on how to enter the building and where to line up. And 2 people in the elevator off peak hours, and peak hours 4 people are okay. And then office doors have signs now that keep 6 feet apart and whatnot. So basically, the sort of red tape that I've long been used to in my industry, in the financial services side, is entering the normal life and entering just an office building. And so that's the new world that we live in. In any case, I will wrap it up here. Before I do that, we did publish a research report today. As many of you may be aware, we publish chart books and several months. This one is on the business cycle. We have another one on the equity market. We have one on the Fed, and then on occasion we publish a few others. And so we try to give a monthly update on these things. And you can still there's a premium and a base set, so you can get a base set for free. You're looking at some data, and then we have a premium set. We are about to launch a new website where we put all of this in a funkier format where it's easier to consume, so to speak. But if you have a chance, if you want to dive into more depth, please look at the report, and then by all means, please look at the premium report as well, because I do think it's worth your while if you're interested in the markets and how the business cycle might be evolving. All right, with that, Have a good one and talk to you soon. Bye.